Thanks everybody. And the background is the cockpit of a Boeing 787.
Wow.
Yeah. So whenever you get onto a United flight, no matter how much you like their service or not, as long as you're nice, you can actually sneak into the cockpit and talk to the captain.
Wow.
And if you are super nice, they will let you sit down in their seat and take a picture. So that's what I did.
Perfect. Looks very nice.
So I can just jump into a quick talk, and I'll make sure I have a ton of time for everybody to ask questions. How's that?
Sounds good. Thank you.
Okay, sure. So I'll get started. Yeah. So hi everyone. Well, I know this is the dinner time for people in California, so many thanks for showing up. I actually recognize some of the names in the attendees, so I'll just do a quick airwave to say hi. And you actually don't have to come because you know the story. So I'm the founding partner of iFly.vc. This is a new early stage venture capital fund based out of here in San Francisco Bay Area, started in 2016. And before that, I spent about 7 years from 2009 through 2016 working for other venture funds, including Vantage Point and Formation 8. Previously, I made investment in companies like Oculus, and that was acquired by Facebook with a pretty good return on investment. So that investment alone returned $200 million to our LPs. But in 2016, when I started iFly, the world was actually not that easy to do a fundraising or in any time for a new manager to get out to the market. There was always a reality check and a wake-up moment. For any of those you entrepreneurs, especially in the audience, that has been challenged by fundraising, I would say don't be discouraged. When I was raising the first fund, I got turned down by over 350 LPs or potential LPs. And I think that number is probably far worse than most of the entrepreneurs who ever try to raise the first or second round for their startups. But at the same time, starting a new VC has no glamour. And so today I'm going to talk about some of the thought process about how we think of a venture fund as a startup, how we found our own strategy and executed to deliver results and return to our investors. And I'm also going to pick one portfolio company that you might be familiar with to illustrate some of the thought process and how we make investment work. So again, going back to 2016, the environment was already filled with over 1,000 micro VCs. And by micro VCs, it means any fund below $50 million. And whether you talk to Silicon Valley Bank or First Republic, there are over 1,000 shops. So it's actually a lot more crowded than any startup segment. So how we really stood out was a key question. But at the same time, if we think of ourselves as sort of an underdog in this ocean, whether it's, you call this bloody red ocean or not, we have to think about our own playbook. There's one book called David versus Goliath, the underdog story that was written by the New York Times bestseller, Malcolm Gladwell. If you haven't read that book, I strongly recommend it because it's talk about not only the story in the Bible, David versus Goliath, but also historically, all these military battles, business competition, and sports game. And I talk about a lot of the stories about how underdogs won the battle, how the underdogs won the competition. And every single time, it's not because the underdogs somehow found more money, better weapon, or beef up their muscle to compete and fight. It's always when the underdog create and follow their own playbook to find their own winning formula. So for iFly early on, there are a couple principles we decided on. And the first one is as an investor, we want to stay away from anything that's driven by a buzzword. If you live in Silicon Valley or most part of the world, you are not immune from the buzzword or the buzzword-centric kind of investment themes. Back then, when I first got to Silicon Valley, it was all about clean tech, then big data, VR, AR, crypto, or blockchain, you name it. But then for an investor, when there's a lot of money poured into the same sector with a ton of a buzz, even the best company gets overpriced. I've seen some cases when people just quit their job at Facebook or Google with a lot of glamour in their title profile. They would just raise the first round for $100 million valuation. And by the way, that valuation was pre-money, not post, right? So for just one idea that's valued at $100 million. Now to me, I have to squish my head how you justify that risk profile at such early stage with such a high valuation. So we said no to that kind of investment practice because our job as an investor, we are not in the business of collecting a lot of expensive logos for the sake of glamour or halo to decorate our website. But at the same time, no matter how hard you look at the venture space, it's never homogeneous. There are always these sectors that seem to be unsexy, unglamorous, but at the same time, super underappreciated, underserved. When it's being ignored by other investors or most entrepreneurs, as long as the problems still stay the same and still meaningful and substantial enough, make it worth solving, then we would love to continue digging in, building our thesis through the research, understanding the value chain, the tech stack, market trend, and talk to a lot of people to formulate our thesis. If we don't see anything, that's fine. There's nobody pointing a gun to our head, say you have to invest in this company, never ever. But if we see something that gets us really excited, if we find something, we come up with our own conviction, then our next part of the principle is that we don't just write a tiny small check, $50,000 here or $100,000 there. Now, what's the point for us to invest in hundreds of companies to build such a massive portfolio without truly understanding every sector or opportunity? So on the contrary, what we decided to do was to build a so-called concentrate portfolio. So that means we are very selective in picking a company to work with. But if we do want to invest, we are happy to write a couple $1 million to begin with. It's not really a fixed formula, but it's just a conviction-driven process. And in our first fund, over a course of 3 years, we actually have not invested in more than 10 companies. So that's how concentrated it is. But the benefit to the fund and our entrepreneurs is, we have just a handful of companies to work with. So we are very motivated to dedicate ourselves, bring our friends, allies, and bring a lot of energy and resource to help these entrepreneurs. And in one case, a portfolio company gave me this personally a title, honorary employee, with even a badge number, 36. It's not because I really joined the team to get a salary or extra equity, but it's really just because collectively the team from iFly have done a lot of work to help those portfolio companies. And when I say this, I want to be careful. I'm not saying our approach is better or superior, but the point is, as entrepreneur, I'm also running a fund, so I have to keep in mind what is the right fit in terms of the strategy that will fit us the best, because we all have 24/7. We all have limited resource and energy and capital. So really find that fit is one takeaway I had from the experience as an entrepreneur building a startup fund. And then when it comes to opportunities, before iFly, I've spent a bunch of years working for other funds. I've got into energy data analytics. I've done smart hardware for home. I've got to exit, like Oculus that is doing virtual reality. But when it came to iFly, we actually decided to double down on the upgrade of consumer experience in North America. Because to us, this is actually a multi-trillion-dollar business waiting to be upgraded, uplifted, or simply disrupted. And the rationale behind this is demand is always evolving. Whether this is a generational change from Gen X, Gen Y, Gen Z, or a migration of people across border, including the immigrants, or simply the shift of people's mentality, aging, and so on and so forth. Whenever demand is evolving and changing, supply is always playing the game to catch up. So that constantly creates a disconnection between demand and supply. And whenever such disconnection is not properly addressed by incumbents, we see opportunities in innovation, in startups, and in venture capital investment. And the other element we like to stress on is, I came from China 22 years ago, and I think naturally compared with a lot of other investors in Silicon Valley, we carry a lot more understanding of the Asian culture and what is happening with the consumer/consumer internet business in Asia, including China. Most of you recognize you are probably Asian, and the competition there is so hot and bloody. But whoever survived and then thrived must have done a lot of things right. So for us, it is important to learn their best practice and avoid their mistakes, and then selectively pick the lessons and apply that to our investment strategy and the value add to our companies in the United States. So a couple examples in the portfolio companies. So we have a company called Border X Lab. They help American and European merchants and brands sell to international shoppers with the initial focus on China. Last couple of years, their top line grew by 300 times. Given that growth momentum, their cash burn was very limited. So when they raised a round from us in 2016, the CEO, the team already built a very sophisticated app. The business was up and running, but they couldn't raise money for 10 months until we led their round. But the business took off, and then the sort of mainstream investors recognized and they came in, and the following round was closed and led by venture funds like Kleiner Perkins in Silicon Valley and Hill House from China. And for us, within 18 months, the valuation went up by almost 10x. And the company is still growing very nicely. And in fact, during this pandemic, especially during February and March, they used their supply chain and logistic capability to secure 500,000 masks for healthcare workers. And then we also have companies like Camp 6. This is early stage investment that focused on developing a autonomous cargo drone. But we're talking about very heavy payload, like 500 pounds to 1,000 pounds, and very long flight range, 500 miles to 1,000 miles. And we're talking about 90 million Americans who do not have easy access to logistics service like Amazon Prime because they live in very far away in those remote areas. And we have a company called Yummy Bazaar. This is a startup on the East Coast that tried to take this $140 billion specialty food industry online. And another company is We, online Asian grocery here in the Bay Area. So I'll take that one as an example to talk through the thought process in a second. And so 3 years into the fund, sorry, I just had to mute myself. I'm not sure, I hope I cut my sneeze. And it's not anything related to the virus. I think I still got this allergy from spring. So 3 years into Fund 1, end of last month, our performance, fund performance in terms of net IRR, TVPI, all these other metrics actually are ranked very high among all the 2016 vintage venture capital funds in the United States. And I think there's one little mistake I need to correct, because in one of the versions of the event announcement, it said, we are ranked as #1 by Cambridge Associates. So I just want to make sure the message is corrected. So that's not true. I don't know who is #1, but we are definitely ranked top tier performance for Fund 1. And we launched our Fund 2. And in fact, I just told my CFO to set up the wire for our very first investment for the second fund. And we are likely to close another investment also in the second quarter. So even though everyone is working from home, our pace has not really slowed down. And so now I'm going to take this company, Say We, as an example to walk through the thought process. We, WEEE, like kids saying we. So this is an Asian online grocery shop in the United States. They are headquartered in East Bay. And when some investors ask, why, are you even thinking about that company? It sounds like a tiny little market. But a couple of things to consider. Asian in North America actually spend about $60 billion on grocery shopping every single year. It is not 100 billion, it's not a 600 billion, but $60 billion, that's actually still a big deal. But for any of you who care to buy Asian grocery, it is a pain in the neck. Even if you are in the Bay Area, you have to drive a long way to get to Asian grocery market. And often the produce is not fresh, pricey. You have to spend a lot of time. And so in other words, the market is being underserved. So when you have a market that is big, but underserved, someone's gonna find an opportunity to make a change. So throughout the last 7 years, actually, I've talked to almost everybody in the grocery business, public companies and startups, and trying to figure out what is the right fit. And the journey with We was also an interesting one, especially for those of you who live in the Bay Area. If you recall, back then, they initially had this operation model of the group buy. That basically means you have to gather a bunch of group orders to get a discount. And some individual would organize that for the people in the neighborhood. But as customer, you have to drive still, 10, 15 minutes to somebody's home, often a garage, to pick up those merchandise. And apparently in 2016, the business was very hot. The business just took off like crazy. And when I saw the numbers and metrics, I was actually very much impressed. But I did have some, well, say not skepticism, but some concern, because the group buy model has a potential risk about the consistency or lack of consistency across the user base and the group buy leaders. When you are small, yes, you can organize these things and people seem to be happy. But when you scale, every single hub organized by individuals without a consistency in quality management, and that could lead to a problem out of control by the company. So that was a major reason I decided to pass, even though the company actually successfully raised a round, pursued by a bunch of investors. But when an opportunity didn't fit our thesis or investment criteria, I would never ever regret about not investing. But then, as again, some of you may know, in 2017, they did run into a brick wall because that model did break down. A lot of complaints. Some of the group buy leaders just went on their own to become independent. The business was taken away. There was a lot of hassle. And even worse, most investors saw a company being challenged. They would just walk away, never answer the call from the CEO. But interestingly enough, I think whenever a company was going through a hardship, that was probably the best time to witness and watch how the founders behave. And in this case, none of the core team members decided to quit. They stuck together and even took their personal savings to save the company. and the founder sold his house to bring cash to the company to pay the bill. And at the same time, they thought very hard about the problem they faced. And the conclusion was people love to access high quality, inexpensive produce. But the model of using group buy organized by individuals were not bad, but had a problem scaling. So they pivoted to have their own logistics, have their own inventory management, pretty much rebuild everything from scratch. And no matter how hard things were to the team, they just didn't give up. And 2018 was a comeback year, and the numbers start showing a strong growth momentum. But again, like I said, most investors had a mental scar, having heard about all the horror stories in history of the company. They just walked away. But I reconnected with the founder of We, and actually I was very impressed about their tenacity and resilience. To me, this is a huge plus when we think about entrepreneurship. And I think the other thing I'm glad about is that neither the founder nor I had any bitter feeling toward each other because we passed on the deal back in 2016. As we got deeper into the conversation, I think we and iFly had a lot more appreciation of each other's insights in the business. And so, eventually when nobody else wanted to invest in the company, we came in, we led a round. And so that's how we got into that investment. And in 2019, after the investment, of course, as I said, we don't have a lot of portfolio companies. Of course, we are super excited and motivated to work with entrepreneurs. We talk about the strategy, we talk about recruiting, and often as a board member, I would insert myself to talk to the key hires, especially the candidates getting to the final round. At the last 15 months, the company brought in VP of product growth, human resource, and finance. Those people used to work for Tencent America or Safeway. And we even brought in the former COO of Netflix, Tom Dillon. But he had a lot of knowledge about operations. That is super exciting endorsement by people in the operation management business. And we were thinking about fundraising toward end of the year. But again, this is where iFly would come in. Our typical approach of helping our founders fundraise was not just to send a bunch of introductions, but back in May and June last year, I started going out to do this little, soft marketing, right? What that means is I would just start having conversation with a list of investors who we think might be interested. We would love to kind of test their thesis, understand their appetite. If there's no interest, that's fine. But if there is any interest, we would like to build a shorter list of potential lead investors. And then in October, as soon as we told everybody we are ready to go, we quickly lined up with a lot of meetings with people on Sand Hill or even in China to talk about that round. And the round was actually closed pretty soon. I think the end-to-end process from the very first investor meeting to the final close of a round was no more than 10 weeks. And for iFly, we didn't want to sell any existing shares. Instead, we decided to exercise our pro rata. That means because we are still very bullish about the company. And somebody just, I think it was about 2 weeks ago, just told me, oh gosh, you guys are extremely lucky because now the coronavirus, COVID-19 is boosting the business like crazy. It's a fantastic bet. And of course, it's nice to hear people recognize the company now more than ever. But honestly, who would be able to predict COVID-19 a year and a half ago? But there was one piece of the thoughts we did carry for a long time. And again, going back to our investment thesis, because when the market was good, startups, early stage, late stage, they tend to raise a lot of money round after round to create this paper valuation game. But for quite a few years, we were actually very concerned because who knows, music will stop running. right? If that ever happened, and if your company has to rely on round after round of financing, you face a lot of challenge. You would face a lot of difficult times because you have a hard time, just keeping yourself alive by not having a sustainable business. So that's also why when we look at actually their unit economics is very profitable. I mean, when I say profitable, it means it's very healthy. They don't have to burn money in order to acquire customers. So that gives us extra confidence before we invested. And the COVID-19 situation is just an extra external factor that differentiates themselves from the rest of the crowd. And for those of you who get orders from we these days, whether you live in the Bay Area or Seattle or LA, now obviously, I'm sure you feel the constraint of the capacity of the warehouse, delivery, and everything. So actually, before this discussion today, I was talking to the CEO, what kind of message he wanted me to pass on to people in the audience who are We's customer. He just said, first of all, thank everybody for understanding of the difficult times, but also, definitely we welcome any constructive feedbacks. And I said, of course, sure, I'll do it, because often I play a role as a part-time customer service rep. So I'll be more than happy to relay the message to the team. And back in early February, actually, We's leadership team recognized potential outbreak of the pandemic. And so they proactively already secure a lot of the personal protective gears, from the goggles to masks and gloves and hand sanitizers. So now they are well stocked to put everybody well protected. And now, just given all the fiasco, the constraint, the stress they have to face, actually they have to work around the clock to make sure every day they deliver to almost 7,000 addresses. And some of the team leaders even just move out of their houses to be closer to work and also prevent themselves from any cross spill of the virus, potentially just affecting the rest of the family. So with that, I think I can just take a pause, because I think we have about 20-25 minutes in case it's better for us to save the time to have open discussion or any Q&A. I'm happy to answer more questions on We or anything related to iFly as well. Thank you very much, everybody.
All right, thank you very much, Han. That's great sharing. So I myself get some questions here, and also for the audience, it's a good time for you to put down your questions so that we can try our best to answer one by one. Well, you mentioned that you're trying to tackle the underserved problem. So can you be more specific about what kind of problem solver that you are looking for?
Yeah, a couple of things. I think, well, we are in Silicon Valley, right? So everybody looks to Silicon Valley as the center of tech innovation, and often fantastic people with incredible academic credentials would come out to talk about dark tech, frontier tech, deep tech, or this tech, that tech. To me, I think the caution I want to add here is tech is just tech, right? Nobody look at the iPhone here would think about all these patents of the nanomaterial used for the battery behind iPhone or Samsung, right? So tech has to be really boiled down to the feature, then into the aggregation of the feature, which turn out to be the product and or service. And the value from such aggregation is really what matters. So the pitfall I found in some of the startup teams is when their mindset is 100% surrounding just tech alone, it's difficult because they lose the sight of the context of the industry, of the business. So typically, my preference is that a founder team is well balanced between the tech expertise and the domain insights. For instance, for We, actually they have a team of software guys data guys. So when they are able to acquire users at a much lower customer acquisition cost than anyone else I have seen, it's because they had a data engine. And then when they are able to deliver everything in such a productive way, and the delivery cost is so low that it can be easily covered by that business. Because I think most of you know, they don't charge any delivery fee if you order more than 35 bucks, right? So the fact they are doing this is not because they found any cheap labor. I mean, this is illegal, right? But it's really because they found all the tech behind the scene to enable a lot more productivity enhancement to make this happen, right? So from the investment perspective, those two attributes are equally important when we talk to founders.
I see. We definitely see that trend coming as well. So as tech bubbles are getting bigger, and now a lot of investors are shifting to the startup that's more close to the business essentials. So my follow-up question is, you mentioned that you have a very concentrated portfolio. However, it against the old saying, never puts the eggs in the same basket, right? Can you please share a failure investments from your past experience?
Yeah, so here's the thinking. When you look at all these investment philosophy, you have to put that into the right context. The opposite of not putting eggs into the same basket is then, how about let's invest in 100 companies every single year. So over a course of 3-4 years, you have a massive portfolio, 300, 400 companies, and each one you put a tiny token amount of money to work. And the reality is, even if some of them became a home run, let's say 50x return, 80x return, 100x return, the probability is low, but I'm saying it's still not impossible, right? But if you hit that, when you look at the entire construction of the portfolio, does that really help you as a fund manager or as a VC GP to deliver our performance at the fund level, at the portfolio level, right? So I think that is a challenge. So when you look to whether it's a stock portfolio or VC portfolio, P portfolio, doesn't matter. So the over diversification is not necessarily helpful unless you understand what you are doing. And there's also selection bias. When people talk about the investment success, again, just like picking stocks, people tend to talk about the good ones they make, right? If you just made a ton of money on Apple or Amazon in the past 12 months, you better disclose all these other dogs in the portfolio that did not succeed or went under. So that's something I think you have to put that into context. But the concentration of the portfolio doesn't mean we walk in being blindfolded. You have to understand the industry nature, the opportunities, the nature of the people, the business, before you find that conviction. But if you do have a conviction, then the question is, again, let me emphasize, if you do have that conviction, right, then the choice is, do you still want to invest $100,000 small check? Or do you think it's worth putting more effort to work? So again, I would not imply who's right or wrong, because we are also work in progress. But it boils down to what is the right fit for you or me, and the answer can be very different.
Yeah, it turns out well, right? So now let's move on to the audience question. I'm trying to put it online, alive, so that everyone can see it. So we got the first question here. Can you comment on the current outlook of US-China VC landscape post COVID-19?
Yeah, so that's a very big topic. It depends on the sector, it depends on the stage. For late stage investments, I'm talking about Series C, D, or beyond. Now, both China and the United States, my friends and colleagues in other funds, they have all raised a very massive amount of money in the past 12 months. Mm-hmm. So I think it's good for them to look for opportunities without overpaying the price. For early stage guys, I think it's less to do with the macro because a lot of the early stage investors for the funds that came out of the past 5 years, this is the time to tell the LPs, show me the numbers. And often it's difficult, it's not easy for anybody to raise a first time fund or even a second fund. The chasm is often going from the second to the third fund because that usually takes about 4 or 5 years. By that point, you have the numbers, you have to tell the LPs. So my anticipation is that not everybody can get to fund 3. Now, I'm not there yet, right? I'm still working on fund 2, but I certainly hope like anyone else, we need to get there. But that can also cause a change in the landscape of venture capital early stage, whether it's the United States or China. But sector-wise, I think it's pretty clear that healthcare would get a lot of boost. E-commerce, food delivery obviously has been pushed by the tailwind. But there are these other concepts. For example, I would say a quote-unquote perk economy will probably just disappear. Right? Back then, when companies trying to toss all these perks to attract talents, maybe some big ones can still afford to do this. But as a service provider or merchandise seller, are you still able to see the same kind of a volume of interest or sales? Now I think just people have to be very careful about where they actually allocate their resource.
Well said. We actually got a lot of questions about we. It's a very hot startup. So what's your view on we expanding East Coast to deal with competitors like Fresh GoGo?
Yeah, so it's just a matter of time. We will expand beyond the West Coast. And I think back then we look at the growth plan. There are several dimensions. Geography is one of them. Further penetration within the Bay Area is the second, right? Because right now the penetration in the Bay Area, even with COVID-19, is still not that high. That means even within the Bay Area, even on the West Coast, there's a lot of work to do. And the third is beyond Chinese. In fact, there's a lot of non-Chinese folks who actually purchased from we even before COVID-19. And last year they picked Seattle, Sacramento, Santa Cruz, and LA to really kind of test how they would expand to a different geography, right? Sort of a kind of test water before you start running. And in fact, each location turned out to be a phenomenal success. It took 6 months in Seattle to scale to what took the Bay Area 2.5 years. And then for LA launch, it took 1 month to get to what took Seattle 6 months. So I think now the team is a lot more strong or mature than a year ago. So obviously I'm not going to disclose when and how we is going to expand and what's the next stop. But I think I'm a very strong evangelist of the company. So I think they have a lot of potential. And I'm not going to directly comment on other players. I think the market is big enough, right? So people can coexist, just like even in the Bay Area. You think about the last few years, even when we is at such a scale, you haven't really heard any of the offline grocery market that went out of business because of we, right? So that means there's a market penetration for the existing business, but there's also additional business can be enabled by we's operation model. Now, for instance, some of the people I know, they just used to subscribe to these organic farm produce. So every day, every week they get a box, right, from the farms. But once they got we, they cancel those boxes, and because they live in a neighborhood that's just so inconvenient to access any Asian grocery market, right? So in many ways, I think when when even these days, when you think about the new teams that came from everywhere in the Bay Area, trying to bring in grocery to customers, I think that's fantastic. As an investor, I don't carry the mentality it is a we versus anybody else. It's not that we have to live and you have to die, right? Because I think it's even good for we to have some level of competition, because that's how we keep ourselves motivated to do better. I think that spirit carries a long way.
Mm-hmm. We is definitely on the right track, and also congrats on their recent closing on Series B. Well, our next question is more about Han yourself. So how did you transit from a chemist to VC investor?
That's a great question. So I came to the States 1998 after I finished my college. My initial plan was to get my PhD at UChicago and then became a university professor. And when I had my first patent back in 2003 or 4, I was thinking maybe I continue the effort and can I even work on Nobel Prize someday, right? So intellectually, I've always been curious, but the journey of chemistry also led me to the exposure to the commercial aspect of innovation, because then I realized it doesn't matter what is going on in your test tube or in a chemistry lab. It has to come to a realization of how that relates to the business potential and the value proposition to the customers. So with that, my curiosity drove me to learn all about the business. So I enrolled at business school between 2007 and 2009. I did my MBA at Wharton, finished 2009, and then I decided to come to the States, the West Coast. And initially, my area of focus was more about clean tech, energy, material. And I think my contribution to the previous firm I used to work was not about an investment I can brag about today, but I actually use my background knowledge and the foundation of the industry to persuade some of those GPs not to make at least 2 big investments. If they ever did those 2 investments, there will be a loss of $40 million. So that was my initial contribution. But the other thing is, I think whether for founders, entrepreneurs, or for me as a venture investor, I think self-awareness matters a lot, because I cannot really compete with others by going to every single event. I can't just socialize, hustle with people and source deals that way, right? So I realized what I wanted to do is to go very deliberate, to get into a sector, to be very deep about it, to recognize these opportunities that seem to be unglamorous, still underappreciated by others. So that's why that goes back to the theme of this talk, is about seeking value in the unsexy. And I think that philosophy applies to both early stage venture investment and then even public stock trading. So over time, it didn't take one night, didn't take overnight to go from a chemist to become, to an investor in online, e-commerce or grocery. It took like all these winding roads to get to where I am. And I definitely enjoy that journey so far.
Great, great. Our next question is from Mark. How many companies have you invested that came to you versus those you found fit your thesis and reached out?
Yeah, I'm sorry. Would you mind repeating the question? I lost a few seconds.
Yeah. How many companies have you invested in that come to you versus those you found fit your thesis and reached out?
I think it's always a mix. It's hard to do a clear kind of a cut, because when we invest, especially in my style, I don't really take a random meeting and then, hey, look, this is awesome, I'm going to jump on it right away. So the process is very deliberative, right? So it sometimes take, for example, my very first exposure to online grocery was back in 2014. At the time, I was like, what do I really know about, online grocery? I knew nothing about it. I don't deserve that investment, no matter how successful it will become, right? But the mentality is, whenever I engage with entrepreneurs, I try to turn that meeting to a useful one, to kind of hopefully ask the right questions to help them also think about the framework, approach, strategy, and so on. Right? Even if we are not the right investor, I learned something, but also I hope my feedback could help them formulate and pitch to the right investor better next time. So, I cannot guarantee I can do this to everybody, but to manifest the value of doing this, just even out of goodwill. 5 years ago, I talked to an entrepreneur in Palo Alto. And of course, it's a space I loved, but I somehow just couldn't really get over some of the concerns I had. So I turned him down, but I introduced 2 of my friends to help him, whether it's a customer's expansion or just simply some advisory Q&As. And then I forgot about it. But guess what? 4 or 5 years later, this founder, his company is still growing and raised money from elsewhere, but this founder and I still connected. And he made an introduction to a family office on the East Coast, and the family office eventually became the LP of my second fund, right? So, set aside all these VC jargon, startups or not, I think it's just a business fundamental that you have to build a relationship as you go, and pay it forward sometimes does pay off to yourself too.
Mm-hmm. All the dots will be connected eventually. So our next question is very specific. Actually, it's from Jian Hong. He has been working with his startup for 3 years. It's a mental health startup in Phoenix, but yet to find a profitable business model. The cost is very high because he has been working full-time almost 2 years. Now he will have to decide whether to stop or get investment due to the own financial constraints. And he's asking what kind of advice you may have for him.
Yeah, so I don't know the business so well because I don't even know anything, right? I cannot really tell you or anybody, oh, just because it's mental health, this is on the rise. You have to do it, right? Again, that's going against my philosophy, whether you should follow the big trend or really figure out what's in it for yourself. But my recommendation is ask yourself deeply, right? What can you see in this startup, in this venture? What can you really see as a motivation for you to keep on going? Part of it is your passion. Part of it is the hard question about the business, about the operation, about what it takes to go forward. Do you have the right talent? Do you have the right network? Do you have the right insights to build it? I think that's something only you as a founder can answer best, and you should do it. I think most people think about startups in terms of perseverance is, oh, let's just keep on going, right? Which is respectable. But the best founder is not just resilient, but also deep thinker to identify these insights. Now, for instance, in Wee's case, if they thought they just had to keep on doing the group buy model by raising another round, they would probably have already disappeared. But they took a reality check and decided to pivot. And nobody can tell them if the pivot was right or wrong. So they had to bear the consequence and account for any consequence they had to observe for themselves, their families. But that's the tough part of being an entrepreneur. The same thing, as me running a startup fund, I face a lot of tough challenges, from the investment to portfolio construction to anything else related. So no one can be in a better position to give you or tell you what to do. But usually, I think those are the set of questions you have to truthfully answer before you make your decision.
It's always tough to be entrepreneurs. So our next question is from Mark. It's a very interesting question. So what matters more, team market fit or product solution fit?
I think they all matter, right?
That's a tough one, tough to compare.
I mean, it's not about comparison. I think the formula of success for a company is like a standard list, right? Mm. If you don't check one of the many boxes, you just fail. So that's why I'm saying, everything matters, right? That's also why it's difficult to succeed. just because you have to check every single box, right? So, and you know, obviously, depending on the stage, depending on the context, depending on, you know, the specifics, maybe you can weigh each attribute differently, right? But you know, I think the other thing is, you know, for those of you who are thinking about getting to startups or venture investment, and of course, just like you know, I also sometimes look up to thought leaders or speakers about their wisdom, what I can learn. But every time I learn from these incredible individuals, the harder part is how to apply their takeaways to the context that you face and drive your own decision. And that's something you just have to keep on going, check and recheck, calibrate and recalibrate. And I think that's essentially how each individual can build, you know, your own learning curve.
Mm-hmm. Our next question is more related to the current pandemic. So how do you find new startups and conduct due diligence without being able to travel meet with startups because of the current situation?
Yeah, so for the two investments we are going to complete in second quarter, honestly, we finished the in-person due diligence before the outbreak, before sheltering in place. So at this point, you know, I just have to be very honest. Whenever we took a meeting with entrepreneur online or on the phone, that, you know, unlikely we can really do it, right? I don't want to fool people by giving them misinformation. So for entrepreneurs, so you have to reassess the timing of the the fundraising. And we have one portfolio company. You know, we help them test water a little bit, right? We caught a few friends that are likely to do the next round and set up a meeting. And quickly enough, we realized, you know, no way. I mean, no one is going to subject themselves or the founder's life or health to such a risk, right? So forget about it. And fortunately, those companies, that particular company still has a very long cash runway. We are not being desperate, right? So for you to think about is how you adjust your path, postpone the right time. But on the other hand, it's also about how you set your expectation, right? It doesn't hurt to still call the investors. But in that case, you should ask the question about these investors' philosophy, approach, their check size, preferred stage, even with their view of the company, right? So always take advantage of the downtime and turn that into something useful. Mm-hmm. Yeah, so for us, you know, besides taking these meetings, you know, online with the startup founders, of course, we also face the challenge that we cannot talk to our LPs directly, but that's also okay. So we got Zoom, we got a phone, we got email, we can still keep the communication going. And at the same time, you know, we are bringing additional interns from top business schools that we are putting our brains together to do even more research. Right? So in many ways, I think work from home only make us busier.
Yeah, indeed. So now it's the last question. That's all we have the time for. And what's the most surprising thing you have learned from a founder, PRVC?
So the surprising thing.
Like bad blood?
Not that kind of stuff. You know, I saw some of the ugly stories in the venture business about, you know, people try to lie, right? And it's not as ugly as bad blood, but no. But let me say this way. I think that the longer I spend my career in the venture business, working with startups, the more I become sensitive about human nature. And the reason I say that is, on the one hand, there's no way for me to be the smartest guy about a subject matter, right? Even though we like to research, we like to go deep. You know, look, the reality is entrepreneurs spend far more hours on their domain. So for us, it's about how we assess their knowledge base, their strategy and everything else. But at the same time, it doesn't matter how smart you are, it's about how you lead the company with a group of people to the next level, to success, right? So the human nature, especially leadership attributes, to me matter a lot. And that's why, you know, about maybe 3 weeks ago, I posted a message on LinkedIn and Twitter that, of course, now some companies just have to shut down for various reasons. And you start seeing these postmortem online saying, look, we are an incredible team of engineers that, we are awesome. We are solving the world's biggest problem. We are ahead of the market. And somehow the VCs lost interest, so we failed, right? But I'm like, are you kidding me? Can you not even be honest with everybody what you as a leader could have done different before things went down? If you say you're ahead of product market, if you're ahead of the market, that means you never had product market fit. How could you allow your team to go like that without adjusting the product strategy to find that product market fit? If you recognize you didn't have that, why would you have, hire so many people? And that's irresponsible for yourself and your team and their families. So if you cannot be honest with yourself about why you failed, I think to me, that's a leadership failure. Just don't blame COVID-19. Don't blame the investors, right? So on the flip side, I think those companies who can go far and beyond, the leader also has to continue growing, right? Nobody, Yifu, me, none of us were born as a leader, right? We all have to learn. But the self-awareness of a startup founder, what is their strength and weakness, what they should constantly learn to grow themselves or bring talents from outside to grow the team together. That self-awareness is also the mental bottleneck of leadership and eventually the outcome of the scale of their success. So your question is about the surprise what I had. I think I knew people matter. Even when I was in business school or even before I went to business school, everybody said, people matter most to success or failure. But it's just that now, after having spent 11 years in the venture business and then 4 years as a founder of a startup VC fund, I would just pay even more attention. And I tell everybody, I tell my LPs, I am the single biggest or the worst bottleneck of iFly. Right? So by saying that, usually I took that as a preemptive way to tell the other party that you are also the bottleneck of your company because you are the CEO. So let's figure out a plan to grow you and me as well.
Exactly. All right. Thank you very much, Han. Thank you for joining today's session. It's always great chatting with you.
Yes, likewise. And I'm sorry, usually when I took a Zoom, I'm on the other side. I usually listen to people talk, right? But this is my second time on a Zoom to talk to like 70 people. And I realized there are a lot of other questions, open or answered or dismissed. Yeah, so I'll make sure I take some notes, and if I can jot down some quick message and relay back through Yifu, and I'll try my best to answer those questions.
All right. Thank you very much. Thank you.
Right.
Thank you for joining us.
Stay healthy. Thanks. Bye-bye.
Bye-bye. And also thank you, audience, for joining us for today's session. And for our up next Thursday, we're going to have Mino Capital joining us to give us a talk. So stay tuned to our newsletter if you haven't done that yet. All right. You guys have a great evening. Bye-bye.